Advanced Financial Modeling, Topic 12, International Finance, Learning Objective number 5. We're going to value international investments using NPV. So to calculate the NPV of an international investment for, say, a US-based firm, we're going to do three things. You want to make sure you convert all cash flows to dollars using either interest rate parity, purchasing power parity, PPP, or unbiased forward rates. So you can't, obviously you can't convert, add up foreign currencies or different currencies. You want to also account for any possible tariffs or repatriation taxes. Repatriation taxes would be when the dollars are sent or when the currencies are sent from offshore back to the States, you get hit by an extra tax. And also you want to include in the discount rate something that accounts for the risk of doing business in that country. So we'll look at all three of these. So we're going to just do one spreadsheet. We're going to jump to that model. So here's an example of Google. Google is establishing a software lab in Tel Aviv, Israel, to sell services in Europe. So what they have are shekel costs and euro revenues. I have the spot price of the shekel listed here at 315. 350, so that's 350 shekels per dollar. The spot price of the euro is $1.10. The Israeli risk-free rate is 3.5%. Euro risk-free rate is 2%. US dollar risk-free rate is 2.5% per year. And the US market risk premium for CAPM is 4.5%. And then here are my assumptions. I'm going to have revenues in euro starting in year 2 of 800,000 euros per year. I'm going to have Israeli costs in shekels at 700,000 in the first year, say a half year effect. And then years 2 through 5, 1.6 million shekels. And then there's going to be a lease expense from years 1 through 5 of 800,000 shekels. We're going to depreciate $500,000 of hardware and so on. So let's go look at this right now. The project life is going to be 5 years and the hardware is going to be depreciated over 7. Here's some other assumptions here. The hardware is going to be worth $50,000 when you salvage it after 5 years. It's a 5-year project. We're going to have net working capitals as a percentage of sales and so on. And this is to calculate, down here is for calculating the WACC. We'll talk about that in a minute. So let's build an income statement and get free cash flows. Well, I need revenues. Well, the revenues are in shekels. I can't use the spot price of the shekel, 350, to exchange cash flows 2 years from now. So what I need to do is forecast the shekel per dollar exchange rate, which today is 350. I'm going to use my IRP model, interest rate parity model, 1 plus shekel interest rates over 1 plus dollar interest rates. So these are the forecasted exchange rates per year. And here is the current spot price of the euro, $1.10, and then multiply that times 1 plus the dollar interest rate over 1 plus the euro interest rate are forecasted exchange rates in the future. Therefore, I can then convert my 800,000 shekels at these 4 different exchange rates. I can then convert these shekels using the different exchange rates. I can convert my labor costs or my lease expense and so on. All right, so the revenues, the revenues are in dollars, the costs are in shekels. So notice I've used the euro exchange rate to convert the revenues, and I use the shekel exchange rate to convert the costs. All right, so then I'm going to buy the equipment in the States and maybe ship it to Israel. So that's going to cost me $250,000. I'm going to depreciate that over 7 years. So there's my depreciation expense. I then have my EBIT, like every other free cash flow model. We start with EBIT, take out taxes, EBIT after taxes, add back depreciation. And then I made an assumption here on working capital. So the working capital, I have an assumption down here is that working capital goes from 0 and so on. It's a finite life project, so the working capital goes to 0 at the end of the 5th year. Therefore, I have my change in net working capital calculated here. I have my CapEx. Here's the after-tax residual. And then I have my FCFFs. This is a finite life project, so I don't have any growth perpetuity or EBITDA multiple at the end. But I did have one other assumption, and that is When you bring the money from Israel or Europe to the States, you're hit with a repatriation tax of, uh, where's repatriation of 5%, but it's only taxed if there's an actual movement of cash flow. So notice here I have, if that number is greater than zero, take 5% off, or multiply times 95, or yeah, take the 55% out. So you only pay the tax if you move money back to the States, and that gives me my FCFFs after repatriation. Remember, there's no terminal value I need to worry about since it's a finite life project, and so I can take an NPV of these cash flows, which are all in dollars, all converted using IRP exchange rates. And the last thing I do is I need a discount rate. Since this is, say, software services, it's maybe different than Google's normal business. So I start with an unlevered software services beta. I unlever that beta to get an unlevered industry beta for software services. I then relever it based on the project's D to E ratio, plug that into CAPM to get a cost of equity, and then calculate a WACC. And then I included a sovereign risk premium in the WACC. All right, so this, again, the sovereign risk premium would be just the difference between U.S. or Israeli and U.S. interest rates, if you consider most of the risk being country risk of Israel. And that was estimated to be an extra 1%. So this is this project. I then calculate the NPV, and it's $21,000. I calculate the IRR, it's 9%. And there I just did a break even there just for fun. So this is how we do an NPV of a foreign project. The only differences from the other topics are I need to forecast the exchange rates and convert all foreign currencies back to dollars based on those exchange rates. I need to also account for any kind of repatriation tax, and I need to make sure that that discount rate accounts for the risk of doing business in that country. So this is calculating an NPV of a foreign investment.